So that's just a start of the interview. So we know you've been focusing on the Sino-Indian business area. So could you make a comparison of these two countries' similarity and difference?
Italian, not Indian.
Okay, sorry. Maybe I googled the wrong method.
I can give you a comparison about Sino-India, but we have been working mainly on Sino-Europe. Okay? So would you like a comparison between India and...
I think we could do both.
Okay. I think it's more appropriate if I give you a comparison between Sino-Europe, okay? Then over the course of the last 2 years, we made approximately altogether $1 billion in Chinese outbound investment to Europe. And we only focus on industrial companies. Now, let me make a brief comparison. First of all, China is fairly homogeneous, and Europe is not as homogeneous. Okay? There are some countries in Europe that have a large industrial GDP, and some countries that have a very small GDP. For example, Germany has a very large share of GDP in industrial activity, as well as Italy, while, for example, England and Spain have a very low industrial GDP. The second distinction is level of proprietary technology. Western Europe tend to have a high level of proprietary technology, while Eastern Europe tend to have a lower level of proprietary technology, because mainly Eastern Europe is mainly dominated by multinational investments. And what was proprietary is not proprietary anymore. I mean, I can think of only one old Eastern brand that survived, Skoda, for example. But that's Volkswagen. There's nothing left of the old Skoda, okay? So, given the fact that when Chinese companies make investment overseas, they really want to buy especially proprietary technology and proprietary know-how. So their ideal target markets are, by definition, Germany and Italy. To a less extent, France, because in France the industrial GDP is not that high and is still dominated quite to a large extent by large state-owned companies. Now, comparing Germany with Italy, right now, the Chinese investment is more relevant in Italy because Italian companies tend to be smaller in size, so easy to access, because Chinese companies are also tend to be smaller because the industrial Chinese segment are very fragmented with a lot of small companies. So in theory, Italian acquisitions are easier because you deal with more niche company, a smaller company. While in Germany, you have larger targets and it is a much more closer market. They don't let you in very easily. So right now, even though we are a Sino-European investment fund, most of our investments have been focused on Italy, up to the extent where we all together, considering debt and co-investor, we have deployed $1 billion. About 700 million euro, which at current exchange rate is about $1 billion.
So we know due to the financial crisis, China has attracted lots of attention. What do you think there are any opportunity for the private offered fund? What's the opportunity?
Very easy. The big opportunity we see in China are pharma. Pharma, I mean both pharmaceutical product, both intermediate active ingredients, and pharmaceutical machinery. Anything that has to do with pharma is very attractive in China. Also, everything that has to do with environment. Every industrial process which is cleaner, every industrial process that cleans the environmental stuff is very much attractive in China. There is a big market. Also, there is a big market for specialized infrastructure machinery. Not generic, not the generic excavator, but special drilling machinery, machinery to make tunnel, that. Those machines, like special cement pumps, that kind of stuff, there is a big market also due to the stimulus package. This in the industrial area. Then, of course, China is very attractive for the service business. Things like health, education, personal care, leisure, these are all fields that will grow more and more because China is doomed to have an increasing share of its GDP taken up by services, software, that other sort of stuff. Like, so anything that has to do with software, with personal care, with education, with well-being, is going to be a sure bet in China.
So what Mandarin Capital has invested on, what sectors you have invested?
So far made 4 investments. One is in a company that manufactures pharmaceutical machinery. Is the #1 company in the world that manufactures machine to produce medicines, from the capsule to the packaging. It's like 11 different market segments. Then we made an investment in a company that make cement equipment. We all call Cifa. The first one is called IMA, which is also listed in Milan Stock Exchange. The third company we invested in is a company whose name is Gasket. It is leading in its field. They make specialized valves for oil and gas, so linked to energy. Also energy is an interesting field. And the fourth investment is a company called Uticals, which is leading in Europe in the field of active ingredients. That are the molecule that the pharmaceutical houses use to manufacture medicines.
So we know state-owned and Chinese state-owned companies, they are very positive on exploring foreign market. They did lots of merger and acquisition. So could you make a suggestion on them? What's your comment on these actions from an expert's vision?
Okay, I have to make a distinction. State-owned Chinese company are not active, are very active in some fields and not very active in other fields. They dominate the investment in oil and gas and natural resources, to the extent where China in 2009, for the first time ever in its history, has the external flow of foreign direct investment is higher than the internal flow. The outflow is bigger than the inflow. And state-owned lead the race in oil and gas and natural resources. Financial services as a sector is dead. After the non-positive experiences done with Blackstone, Morgan Stanley, Fortis, and Barclays, finished. Investment by state-owned banks and stuff in financial services, finished. Then we are left with industrial fields. State-owned enterprise, with one limited exception, do not yet invest in industrial fields. It's mainly private Chinese investors who are looking at the industrial field. But the industrial fields, Chinese companies are even state-owned, are left a little bit behind.
Do you think there's any change in the future in terms of their focus, whether they will invest more on other areas in the future years for Chinese state-owned company?
There will definitely be a change, but the investment on the industrial field is much more complicated for Chinese than the investment in natural resources in oil and gas. And the reason is, there are a number of reasons, okay? The first reason is Chinese are much more experienced at mining and oil exploration and drilling. I mean, they're worldwide. Chinese companies are big, they understand their business very well, and they are plugged into the global network. And they can see the opportunities wherever they are. The opportunity whether they are in Gabon, or whether they are in Kenya, or whether they are in Australia, or whether they are in Brazil. They are around the world, they are part of their global network, and they are in, okay? And they compete head-to-head, you can see them anywhere. When you come down to industrial investment, the opportunities are not global. The opportunities are more local. If there is a company sold in Spain, that doesn't go in a worldwide circuit. You need to be plugged into Spain. If there is a company sold in Norway, industrial company, you have to be plugged into Norway. So to access opportunities in industrial investment, you need a network which is much more fragmented and localized country by country. And still, Chinese companies do not have such network because there is a principle that we all have to adhere to, that you only buy a company when that company is on sale. This is I give you an example. That's very interesting. A Chinese company comes to me and says, I would like you to buy Giorgio Armani for me. But if Mr. Giorgio Armani does not want to sell his company, there's nothing I can do about it. I mean, if I'm lucky, he's going to ask me such an astronomical price that is not going to be a good price to buy. You only buy a company when the owner has decided to sell. That you buy. So in order to know when a company is on sale, you have to be plugged in early on in the network. This happens in oil and natural resources. That doesn't happen in industrial.
So how you look at the deal between Sichuan Zhongmi and the Hammer? How you look at it?
You asked me a very tricky question. You know, I've lived enough in China to understand how tricky it is. Without knowing much about the deal itself, from public information I can tell you the SUV market is a declining market. And they probably are going to require restructuring. And that restructuring is going to take place mainly in the United States because the factory is still there. And that comes my statement. Chinese companies, Chinese entrepreneurs are very good at growing, but they are not as good at restructuring because Chinese entrepreneurs have been managed growth for 30 years. Restructuring is a different business. and that's the second point. Growth is growth wherever in the world. Okay? Actually, growth at time is easier outside of China than in China because, for example, outside of China you get easier financing. But restructuring changes by country because restructuring depends on labor laws, on unions, on bankruptcy laws, on judges. So restructuring is a very complicated game. So I would never recommend a Chinese company to buy a foreign company which is in or near or likely to be in restructuring. And this is the impression I have of the Hammer deal. It's a deal that soon is going to require restructuring, and it doesn't seem on paper the ideal deal for a Chinese company on the basis of the public information I have, of course. So I could easily be proven wrong.
So China and the U.S., they just promised there will be no more trade protections between them. How you look at this promise? How this is gonna influence the relationship between China and U.S.?
Well, this, of course, has nothing to do with the Hummer deal. Okay, this is outside the Hummer deal. Second, this promise I quite don't see. Because when you talk about America, one thing is the president, and one thing is the Senate and the Congress. They're two separate things. Not necessarily the Congress and the Senate does what the president wants. Okay, so I'm not sure that this promise is implementable on the American side, because congressmen and senators have pressure from union members, have pressure from companies, some companies. So there will always be a tendency at the congressional and senatorial level to increase the protectionistic pressure. In the end, I think it's no big deal for anyone. So these are all fires and eventually will go away. I think China is handling very well, going to the WTO. Probably the U.S. will lose the WTO case, and China is managing well. But I'm sorry to contradict you, but if they made promises, I don't think America can keep them. And it doesn't occur to me that America had made any promise. They probably promised their best effort, but they didn't promise they won't happen. Okay?
So how are you looking at the growth enterprise market? What are you looking at? How do you look at its influence on privately offered fund? How are you looking at it? How this is going to influence the private equity market? I mean the growth enterprise market. You know, they just
the U.S.
No, the China. There is a new security market.
Not at all. I mean, we are talking about big aggregate, and the GEM, is a small entity, and there are a lot of high growth company in China that are eligible for the GEM, whose growth is absolutely not dependent on the growth of the U.S. economy. A lot of the companies that plan to be listed on the GEM are in the service sector, the one I mentioned before, that are not exposed to international trade. So I really see the relationship between the growth of the GEM and the growth and the change in U.S.-China relationship as two very uncorrelated items.
Thank you very much. We're finished. Thank you. You're very easygoing.